The global energy market is entering another period of heightened uncertainty.
Now, while our diplomatic efforts have temporarily eased direct tensions between US and Iran, threats to key oil shipping routes still remain far from over. Refined fuel inventories are tightening, diesel exports from Russia have been curbed, and analysts warn that any further disruption could actually send oil prices sharply higher. Here's a closer look as to why the global energy markets are on edge despite signs of easing tensions.
The global oil market is facing mounting pressure as conflicts spread across some of the world's most critical energy corridors. While the US and Iran have paused direct attacks and diplomatic efforts are underway to reopen the Strait of Hormuz, uncertainty remains over the future of one of the world's busiest oil transit routes. At the same time, Iran-backed Houthi rebels continue to threaten shipping through the Bab el-Mandeb Strait, another vital passage linking the Red Sea to global markets. Analysts warn that if disruptions occur across both choke points simultaneously, global energy supplies could face severe constraints. With tensions also persisting in the Black Sea, the risk of a broader supply shock is rising.
Ultimately, the costs will be passed on to consumers. One of the key things to note about the Bab el-Mandeb blockage is we also see a lot of diesel, flow out through there. So diesel is used for all sort of industrial processes. So the cost of manufacturing, so the cost of finished goods to the consumer is going to rise.
Beyond crude oil, refined fuel markets are showing even greater signs of stress. Ukraine's attacks on Russian oil infrastructure have reduced Russia's refining capacity, prompting Moscow to curb diesel exports to protect domestic supplies. According to Rystad Energy, global commercial and strategic crude inventories stood at roughly 4.4 billion barrels at the start of the Iran conflict, compared with only about 1.4 billion barrels of refined fuels such as gasoline, diesel and jet fuel. Since then, both crude and fuel inventories have declined by around 200 million barrels each. With a much smaller buffer for refined products, gasoline crack spreads in the US have surged from around $8 per barrel at the start of the conflict to between $40 and $50. The widening conflict leaves policymakers with limited options to contain another energy price spike. Emergency oil reserves have already been heavily drawn down. US refiners are operating near peak capacity, and measures such as waiving the Jones Act have already been used to improve domestic fuel distribution. Market analysts warn that if both the Strait of Hormuz and the Bab el-Mandeb Strait face prolonged disruptions, Brent crude could revisit levels near $124 per barrel, last seen during the recent conflict peak. With geopolitical risks now stretching from the Persian Gulf to the Red Sea, Black Sea and even the Caspian Sea, energy markets are increasingly vulnerable to further supply disruptions and renewed price volatility. Business Bureau, WION World is One.